Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest. Well, we're talking about inflation, and it's a topic that's on everyone's mind. The latest consumer price index, or CPI, numbers are out, and they show a 2.9% rise in July, with core CPI, which strips out food and energy prices, up 3.2%. Now, while these numbers suggest that inflation is cooling, marking the fourth straight month of decline, it's important to note that we're still above the Federal Reserve's target of what they call 2%. Now, this raises a big question. Will the Fed actually move forward with the rate cuts that some analysts are predicting for September? But here's where it gets more interesting. Nearly 90% of the monthly increase in CPI came from shelter costs, which actually accelerated. Rent was the stick in the mud in this report. And this could signal that inflation isn't falling as fast as we'd like it to be, potentially giving the Fed reason to hesitate. But on the other hand, we've also seen strong consumer spending with GDP growth, which might keep us out of recession for now. Our next guest, Adam Taggart, spent 30 years on Wall Street and Silicon Valley before founding the Thoughtful Money podcast. He's here to break down what these inflation numbers mean. He's also a gold guy, so we'll chat to him a little bit about that too. Adam, welcome to Kitco.
Hey, it's a pleasure to be here, Jeremy. Thanks so much for inviting me on.
Okay, I feel like I know you, Adam. We've been chatting a little bit, and we got lots to get to. Obviously, the news cycle has been a little bit fierce and in our face. But we're talking about this latest inflation report, and it showed that prices are cooling down. CPI rising 2.9, core CPI by 3.2. Some analysts, of course, are suggesting that we're going to see a cut in September, possibly 25 basis points, and then some are in the 50 basis points camp. Where are you? What's going to happen with this cut, you think?
I think it's probably likely that we're going to get a cut in September. I do not think we're going to get a 50 basis point cut, just to be clear right up front about that. First off, I think it's important to keep in mind, the market is super excited for rate cuts to come. It has been for a long time. Coming into 2023, the market was expecting the Fed was going to be pivoting at any moment. Jerome Powell had to continually tell the market, nope, I'm going to stay higher for longer. Nope, I'm going to stay higher for longer. The market kept saying, I don't believe you. I don't believe you. But who had to blink in that game of chicken? It was the market. It's the market all the way along. Even coming into 2024, you probably remember there was a time when the market was expecting somewhere upwards of like 6 rate cuts from the Federal Reserve. Still hasn't happened yet. Right. So I think Jerome Powell is serious that he's going to, take the time he needs to feel confident that inflation is coming down on the trajectory that he needs it to come down on. Now, that being said, I think the Fed is going to take heart from this latest inflation report. CPI, headline CPI, now has a 2 handle on it. Right. I think that can make the Fed, feel like, OK, I'm showing the world I'm getting the job done here. I think it is taking longer than the Fed would like, obviously. One last thing to think about here too is the GDP growth for Q2. The initial report came in at 2.8%. Yes, the unemployment rate is rising now, but even still at 4.3%. That's historically a low and considered very healthy unemployment rate. The market is near its all-time highs. The real estate market is at all-time highs nationally on average. So these are generally not conditions in where the Fed is doing aggressive easing, rate cuts. If anything, these are conditions where the Fed is sometimes asking the questions, hey, is the economy maybe performing too well and we still need to cool things off? So, I do think for those that are expecting 50 basis points or even more. I know one prominent economist that called for an emergency 75 basis point cut and then another 75 later in the year. I think they just need to slow their roll. I do not think that's going to happen.
Yeah, I mean, you mentioned it. We started at the beginning of the year talking about 5, 6, 7 interest rate cuts. And here we are. I mean, we've been also talking since the beginning of the year about seeing these cracks in the economy and, this possible recession, the big R word, as we talked about. We've definitely been hearing a lot about it this past week. The latest data shows that inflation's easing with some signs of weakness in the labor market. But how close do you think we are to a recession?
I think there are pockets of the economy that are probably likely in recession. And if you talk to the average consumer out there, 3 out of 5 consumers say that their household income is not keeping up with the pace of inflation. So I think that there's a good chunk of the populace that would say, hey, I don't care what the headline numbers say or the official numbers say, I feel like I'm in a recession here at this point in time. To the spirit of your question, though, I think it is going to get worse going forward. I can't say with confidence when a recession will be called. Now, obviously, we just had the Psalm rule that was triggered a little over a week ago. So technically, by that indicator, the economy is in recession already. But if you look at everything from consumer spending to consumer levels of indebtedness, to if you just scratch below the otherwise rosy headlines in the jobs market, you find a lot of really heavily concerning data where hires have dropped back down to pre-COVID levels, quits are down, which shows that people are worried about being able to find a job if they leave their current job. If you look at the fact that pretty much all job growth creation that has happened has been in part-time jobs and not full-time jobs, if you see that hours worked are slowing down, these are all pre-recessionary signs, right? So I think that even that 2.8% Q2 GDP growth that I mentioned earlier, that rate, that's an initial reading, and those initial readings tend to get revised downwards. And in a lot of the data that I just mentioned there, whether it's GDP data, whether it's employment data, or whatever, the strong trend over the past year or so has been that when the current number gets published, all the previous numbers get revised downwards. And that process doesn't seem to be moderating at all. In fact, it's probably getting worse. So sort of my long-winded answer here is saying, I think we're seeing an increasing number of signs that the lag effect from the Fed's historically aggressive rate hiking campaign are finally beginning to show up. I think Wall Street had really begun to hope and tell itself that it somehow had dodged a bullet and somehow this time was going to be different and the Fed was going to have engineered this immaculate disinflation, this soft to no landing scenario. I think the hard landing is probably likely still the probable outcome here. It's just taken its time to arrive, but I think we're finally at the point in the timeline where it is increasingly beginning to arrive.
Yeah, it almost seems like, we get these revisions and the Fed has almost lost some credibility here because we get these revisions to the data and it says, okay, it's not as good as we initially thought it is. And then I talk to people at home that are just the average Americans and they say it's really tight out there, not to mention credit card debt. So, as we look ahead, what do you think the biggest challenges for the U.S. economy are? It's a pretty macro question, but we got a lot of things coming up this year.
Well, we got a lot of things coming up this year, and obviously a really big one is the election. And if you're up for it, I'll share my little armchair opinion on what could happen post the election. I think regardless of who wins, the incumbent at the time or the person coming in at the time is going to have a personal interest in letting a lot of the current froth that's in today's markets and a lot of the extraordinary engineering that's been underway to make the economy look as good as it can heading into the elections. I think whoever wins in November has a personal incentive to let that stuff end and let some sort of expression of natural forces remove the froth. And the reason why I say this is I don't think it's a surprise to anybody or would be a surprise to anybody that the Biden, now Harris administration, has been using a lot of unnatural acts to try to keep things as belted together as it can to get to the election day. And they know they can't do that forever. They know that there's a cost to that. So if they get reelected, if Kamala Harris wins, she'll say, look, you know what, let's let some of this stuff correct because we're going to have to. Let's have it do that early in my tenure. So yeah, maybe I'll have a rocky first year or so, but then things will bottom out and then I can really finish strong and I can look great in 4 years, right? Similarly, if Trump were to win, first off, the Harris campaign would stop doing what they're doing anyways because, hey, we don't want to help that guy at all. And secondly, he would say, great, let it all correct. I can blame it on the previous administration for my first 2 years. And again, I can end strong and look like a hero at the end of my years 3 and 4. So I feel like, look, there's lots of reasons on the macro side to expect things to slow down, get harder, to expect market returns to get more challenging going forward. But I think we have this event with the election where the people who have been trying to hold the system together and make things look as rosy as possible to date actually have an incentive to stop doing that for at least some period of time.
Yeah, interesting. Okay, so then, I mean, they've obviously put a lot of money into the market. We've seen it with COVID. We saw the stimulus. We're starting to see it come out. If we're going to go into this type of a scenario where between candidates, we're still going to see a slowdown, maybe a bit of a correction in the markets next year, where are you putting your money then? Where's the opportunities? Where's the risks? What should we be doing here?
Sure. I mean, I think the biggest opportunities right now is, look, there's not a lot of things that are undervalued. In fact, I think you and I could probably have, a really good conversation about all the things that are overvalued and how overvalued they might be. So I think the general risk to asset prices, especially if the status quo starts changing, is to the downside. So I think the opportunity here is to basically preserve capital, so that if indeed there is the type of correction that you and I are talking about, you're sitting in the catbird seat with dry powder to deploy at better valuations. And who knows how long they're going to last, but being able to park a fair amount of your capital in short-term U.S. Treasuries yielding 5% still, not that bad. If you expect that inflation is going to come down over time, then interest rates are a function of inflation expectations. There's potentially emerging opportunity on the longer duration side of U.S. Treasuries as well. And that might not be a bad place to put some of your portfolio right now. I'm sure we'll talk about the precious metals in just a moment there too, but that is one asset class that actually seems like it's got a lot of good tailwinds behind it for a reason right now. And that could potentially buck the trend of what we're talking about. Although even precious metals themselves, if there's a general market sell-off, will probably get sold off at least at the beginning of that for margin call reasons.
Yeah, it's been so interesting just watching the diversification of portfolios in this market too, because you mentioned it, you're taking 5% off a T-bill, not the worst return. We started the beginning of the year with almost $2,000 gold. Now we're at all-time highs. We're almost at that $2,500 range. Let's shift over there because I know, Adam, you talk about gold quite often. You're a bit of a gold bug like me. It's been having an interesting year. Obviously, central banks keep picking it up, but we've been seeing consumers start picking it up. Talk to me a little bit about your outlook this year. Anything surprise you?
Sure. Surprise me, maybe just that, gold has finally started to make the progress that I think folks like you, gold watchers like you and I, have been expecting it to make over time here. I think, like many people, I invest in gold, not because I like shiny metal, but because I have a concern that the purchasing power of our currency, and this applies to all fiat currencies, not just the US dollar. But I feel like that is the safest bet that I can make, Jeremy, is that over time, the purchasing power of the US dollar and other major world fiat currencies is going to continue to decline if our policymakers continue to pursue the policies that they have been pursuing. I don't see any changes to the policy strategy going forward. So again, that's why I think this is one of the safest bets to make. And it's a big reason why I invest in gold. I mean, it's not just me, it's like you, I interview a lot of experts for my day job. And even just recently having interviewed Thomas Honig, who was a former head of the Kansas City Fed, and then was a voting member of the FOMC under the Bernanke era. That's his opinion as well. Right? It's the surest bet that he knows how to make. So anyways, if there's anything I'm surprised about, it's pleasantly, is how well gold has performed this year. And I think will continue to perform from here. And part of what's driving that is, like you, I interview a lot of folks that are, really steeped in the precious metals. Grant Williams, I was just talking with him yesterday. Guys like Ronnie Stafferly, who writes the amazing and amazing in quality, amazing in length in Gold We Trust annual report. Grant is famous for having written a report, getting close to 8-9 years ago, about gold, which was that nobody cares. And us long-suffering precious metals investors, remember back in those days where we were buying gold for all the reasons that I think most investors are buying it today, but not seeing the response in gold, even despite QE and all the money printing that was going on post GFC. And I got a chance to interview Grant yesterday, and I asked him, all right, Grant, so where are we? Does anybody care about gold? Is the world starting to care? And he said, not everybody, but increasingly important cohorts are. So central banks are definitely caring about gold. They've been buying at record levels for much of the past couple of years. That trend doesn't seem to show any signs of slowing down going forward. The Eastern investor has been has cared a lot about gold. And when we look at the shift of gold ounces from west to east, they're basically willing to buy as many as we're willing to send over that way. It's been the Western investor who really has been asleep at the switch. And while Grant says they still largely are, the Western investor may be actually finally cracking open an eyelid to see what's going on here. And why I think that's so exciting, and this is where I get, pretty sanguine about gold's prospects from here, is Wall Street really doesn't like gold very much generally. But what Wall Street loves is momentum, and gold is starting to show momentum. And Wall Street will jump on that bandwagon at some point. And right now, I think the average portfolio allocation in the West to gold is something like 0.5%. And historically, that's been more somewhere between like 2 and 4%. So, gold allocation could easily quadruple from here and just get back to historical averages. So if the momentum behind gold causes Wall Street to wake up, Wall Street jumps on that bandwagon, and Western capital really starts flowing into the gold market, that's going to have an explosive effect upwards on the price of gold. And I think things could get really exciting from there.
Yeah, absolutely. Everyone's just waiting for it. It seems like they're buying it from Costco, but maybe not touching it yet on the Western front. Okay, speaking of metals, we got to talk about silver for a second. It hasn't really taken the spotlight during this recent metals rally, despite its industrial uses, potential in the green energy sector we talked about. Were you surprised by silver's performance, or is it just simply lagging behind gold for now?
I'll say yes to both questions. Not shocked by the fact that silver's not doing, not participating in the gold rally yet. I mean, let me say though, it's gotten above 30, right? It's just cooled off a bit here. I mean, it's not like it hasn't done anything, and it's moved quite far when you compare to where it was just a few years ago. But as a long-term silver holder, in the short term, silver can break your heart 1,000 ways, and so. Part of me is just tempered by that experience. And historically, when the metals move, gold leads, silver follows, then the miners generally follow suit. I think we're going to be seeing that pattern here. So I still very much expect silver to start playing catch up to gold. And even if gold doesn't, it's knocking on the door of 2,500 an ounce right now. Even if it stalls here for a while, I can make a pretty good argument that silver should still slingshot at some point up into at least the mid 30s, just based on that alone. Of course, if gold has the type of future ahead of it that I think it may have for the reasons I just mentioned earlier, I think we could see silver, $50 silver is not, it wouldn't shock me if we saw that in the next 12 months.
Yeah, totally. Especially if we consider where silver and gold, like you mentioned, have come in the past 9-10 months. It's wild returns out there. Adam Taggart from the Thoughtful Money Podcast joining us from California today. Hey, thanks, Adam, for this. I really appreciate making the time, and hopefully you can come on and we can do this again.
Hey, I was honored to be asked, and it was a lot of fun, Jeremy. I'd love to come back on anytime.
Thanks, my friend. Have a great day. I'm Jeremy Szafron for all of us here over at Kitco News. Thank you for watching. Stay tuned for more content coming your way. Don't forget to hit that notification button to stay up to date. We'll see you next time.